Welcome back to another Wealthlab episode with Scott and Phil. In today's episode, we are talking risk profiles, making money, and maximizing your returns. So, Phil, let's get into it.
Yeah, I see this is like when I'm having a client meeting, getting through to into the risk profiling, which I guess we'll explain what that is in a minute. But getting into that part of the conversation is probably one of my favourite parts of the meeting. I love seeing how people think and how they react to some of the different questions we throw out there. So yeah, this is a cool topic, I reckon, something I like talking about. Yeah. So I suppose when we talk about risk profiling, it's part of the process that we go through with new clients as you're coming on board, where we sort of run through a question set around different investment concepts and kind of how you would feel about different things. And it's just trying to get a real sense of what you may not be comfortable with in terms of investment, but also kind of educating you along the way about some different investment concepts. So that's, I guess, the process in a nutshell. Scott, you got anything to add there?
I might say it's a very financial planning term to say risk profile. What that actually means is that's what's your investor preferences. So you as a person that is coming to talk to us, we need to understand what types of preferences you are most comfortable with, where you'd like to have your money invested, where you don't want to have your money invested. And we use the term risk profile from a financial planning perspective to actually take you through the process of categorizing what will be a good match for you, and then we'll customize the portfolio around what your preferences are, what your experience is, what your family's views on money, what your sort of cultural views on money, and where you are comfortable to go forwards. And I think the purpose of this podcast is we can give you a little bit of education around what goes into that process and how we can help you to understand that process a bit more.
Yeah, I always find it's funny. Like, I think if you ask most people, I think a lot of people, at the start of the process, sort of, what do you think? Where do you think you are on the scale of conservative to a risk taker? And most people will tell you they're pretty conservative, but then they'll tell you they bought 3 investment properties and whatever else, which is generally pretty, it's a higher risk strategy. You're borrowing money to invest in a single asset, so it leads to some funny conversations. And then a lot of people just naturally think, we start asking questions around volatility, which is the ups and downs in your money, or the potential losses, which is like, the year where your super fund went backwards by 10%, those kind of things. Most people would naturally say, I want to avoid that kind of stuff. But actually, there's real risks in being too conservative as well. So I did bring a couple of things I can share to that end. But have you got anything to add before I jump into that, Scott?
All I would say is that when a suitable risk profile is like is somewhat similar to this when you drive down the street and you can see the speed limit signs. If you are driving on a road that's 100k an hour and you're doing 65k an hour on a 100 road, you're driving too slow. You're causing chaos behind you and you're not going fast enough. Alternatively, if you're on that same road doing 150k an hour, trying to get to that end goal where you want to as fast as possible, the likelihood of you falling off the road exponentially increases with a linear level of speed.
I like that analogy.
It's about trying to get the right speed. So we need to get you to where you want to be in a safe manner, but also in a way that's not going too slow. So there are some guardrails we can put in, but we can take a bit of risk in a portfolio because we have some tools that do work pretty well to help grow wealth. But yeah, that's the analogy that I like to think of when I'm talking to people.
Yeah, that's a great analogy. Actually, I like it.
Yeah, you can use that one, Phil.
Thanks.
We should do a
podcast
on it.
That. Yeah.
For those that are listening, we are looking at a fairly squiggly chart, which Phil will explain.
Yeah. Most people, when I ask, are you open to having something that's potentially going to have big losses along the way, but will give you more growth potential, or do you want something that's going to give you nice smooth returns, no risk of loss, or low risk of loss, I should say. We can never say never. What do you want to do? And most people say, well, I'd much prefer to have a low risk of loss. I don't want to lose any money. So the reason I pull this chart out is it kind of illustrates a point. Now, and I also want to highlight that this dark green line here is Australian shares. Yeah, it's the ASX 300, so top 300 biggest companies in Australia, effectively, when I think of it that way. This is not you going and picking some dodgy mining specky and expecting it to perform in line with the Australian share market, right?
Damn it! I wanted my my tokenized medical marijuana stocks.
Yeah, not going to work.
Damn.
So yeah, so when we're talking about this, it's a well considered, well thought out, broad diversified portfolio, and that's the only kind of things we're talking about. We're not throwing into tokenized marijuana medical stocks or whatever Scott's waffling on about there. So if a client says to me, I want a nice smooth return, I don't want any risk of loss, cool, we can find that for you. And that's what this purpley coloured line, I guess, looks like. This is cash returns in Australia from 1989 through to 2021. You can see that's a nice smooth line. You haven't had any major dips like global financial crisis. The share market and the property market had a massive tumble, but cash just ticked along doing its thing. You've increased your investment a little bit. What are you going from $1 to $3?
And for someone who's listening, cash is a very smooth line. So if someone who's gone, I want a smooth investment return that just kind of keeps going over time, great. The only option is cash.
That's right. And so, yeah, you've gone up a little bit. You've had a nice smooth ride to get there. In contrast to someone that's just said, you know what, let's go hard. Happy to take a bit of risk, throw my money in shares. Which again, we're going to be more diversified than that, but for the purpose of the conversation, if we threw it all into this dark green line being the Australian share market, it's a pretty wild ride. You can see there's a lot of ups and downs along the way. We've had some reasonable crashes, but overall, over the long term, upward trend, which is what we're looking at. So we're taking on some ups and downs and some, maybe temporary discomfort in times like this. The trade-off for that is, instead of having $3, we've got nearly $7 million 50 over the same time period. So that's a very simple illustration of the concept of risk and return. Now, some people still say, look, I'm happy to just get the $3. I still want the smooth ride. But the story doesn't end there. So the next thing I'll sort of introduce is inflation. And look, I always like to explain it with a bit of a personal anecdote that, before I was a financial planner, I owned a coffee shop. I sold a cup of coffee for $2.50. And I remember people blowing up when I put the price up to $2.60. You think about what you paid at your local cafe for a cup of coffee this morning. It's probably $5, $6, $7, depending on where you are and what you're buying. That there is inflation in a nutshell. Stuff's going to get more expensive as time goes on. The reason that's a risk when we're talking about investing, retirement planning, all that sort of gear is we're saving today to pay for future expenses. This green line in the middle is cash returns over 10 years. So if we equate that to the previous chart, purple line, green line, same thing. So over that time, we've gone from $1 to $1.05 in cash. So you've made $5. That's pretty cool. The problem with that is your purchasing power to buy $100 worth of stuff now 10 years down the track, you actually need nearly $116. So you can't to buy what costs you $100 today in 10 years time is costing you $116. Right? So if we show that as a real return, $100 has gone to $105.
Geez, I'd love to see this. I'd love to see, because this is as of 21, because the UK at the moment, post Brexit, is actually the only OECD country that's actually having inflation expand. So inflation in the UK is going faster today than it was last month, versus all other major economies, which is inflation is on the way down. And that's just because they have a unique circumstances of Brexiting themselves out of a major labour economy.
So basically what Scott's saying in English is that they've just exacerbated the problem, yeah?
Yeah, thanks, mate.
Yeah. But look, essentially what we're looking at here is your loss of purchasing power. So even though you have not lost money, technically your balance has gone up, your real rate of return, or what you've actually earned on that money, considering the loss of purchasing power, is your $100 is now only worth about 87. So by taking a really conservative position, trying to avoid those ups and downs, you've actually guaranteed yourself that you've made a loss, as opposed, which is kind of counterintuitive but for most people that are thinking about it. So anyway, that's the point I wanted to get across. So I thought it's usually an interesting conversation.
It's a tactical choice. Leaving money in cash is actually a strategy. So some people say, well, I've got no strategy. I'm just going to leave the money in the bank. That still is a strategy. It's just a very, very simple one that is a guaranteed to create a loss-making trade over time. And the point of using an advisor is to be feeling safe and secure that when we do invest your funds, it will outstrip inflation over time, protect the purchasing power of your money, and be there in the future so that you can live off it. So that would be the key element to that.
Yeah. But the other thing I'll just throw on quickly before I shut up and let you say something, Scott, is, like these big crashes along the way, right? Global financial crisis, COVID, whatever's going on. If you're still working, you're still young, you've got a long time ahead of you, they really don't matter. You've still got plenty of investment time frame ahead of you. Really, what this means is that every time my employer throws $1 in or every time my salary sacrifice, I'm just shopping while stuff's on sale. Yeah, it's ASX 300. There's still big quality companies. The likelihood of all 300 top companies in Australia going bust is at the same time. I wouldn't say that's great. I wouldn't say it's a great likelihood. So, you're shopping while you're on sale. That's cool. It's the problem if you want to retire tomorrow. But as you get closer to retirement, we can start to put some strategies in place to help mitigate that risk. We've got tools in our toolbox for that. So, anyway, that's something your advisor will talk to you about.
Excellent. I love it. So it's making sure that you manage what's called sequencing risk, which is you retiring at the worst point in time, as opposed to being able to continue to manage that, either continue to work further, having enough assets, or just being diversified enough that major shocks in one asset class don't affect your entire portfolio.
Yeah, that's
and that
right.
is
Exactly.
Getting back to.
I think that was the last point I wanted to make, but I do want to make one more. Everyone loves to tell me that property is way more secure than shares and it's a nice, safe investment. And I just want to point out that property is the light green line and shares the dark green line. Yeah,
Share never goes backwards. Well, it's the safest asset you could possibly have. Isn't that what we all say? Is that what the real estate agents say?
It is. So sometimes I have trouble getting that point across, trying to explain to people that, borrowing money to buy an investment property is actually a high risk strategy. Here it is. Here it is in the chart.
Squiggly lines again. We're back on asset class investment growth. Yeah. So what are we looking at here?
What I was talking about is, that point of, people love to tell me that property is a nice, safe asset and it's more secure than shares. And I just wanted to highlight the point that light green line is property and the dark green line is shares. So you can see they're actually pretty similar in volatility.
So for those listening, the dark green line has performed a better rate of return than that of a property. Is that what we're saying?
No, what we're saying is they've had a pretty much equally wild ride along the way as well. So the volatility is very similar.
Okay. But my house hasn't moved up in value as much as the shares. It doesn't move as much. So how does that make sense? What do you mean?
Well, the way I like to explain that is, you see the volatility in shares, right? They've repriced hundreds of times a day because of the way the market works. Your property, you're going to look at the value when you buy it and when you sell it, and you probably don't really care what happens for the 10 years in between while you're living in it. Some people look more frequently, but imagine you auctioned your house hundreds of times a day, every day. You're not going to get the same price. It's not going to be a stable price, right? So, stupid example because we're not going to do that. But just because you don't see it doesn't mean it doesn't exist.
I like it. Nice. Thanks, Phil. All right. So this is just getting back to the core principle of what we've been talking about, which is that when we come to a risk profile with you as a client or a person considering working with a financial planner, this is just what we're considering in the background of where we may place you. So a higher growth profile will have a much higher allocation of direct Aussie shares than a lower risk profile. And what that means is it will be smoother, but it will be more risky from a inflation perspective, but it will be less risky from a volatility, so moving up and down day to day. So personally, I do try and steer people a little bit closer towards the growth profiles. I know I have a bias towards that because I think if someone's paying us for our advice, we should give them the comfort that a well-managed professional portfolio that has a higher component of businesses that are doing good things, that are creating valuable assets, will then generate income and grow. So what I've got here is I've got a sheet that I'm just going to show guys, this is like a very, very simple academic type box chart, which is high risk equals high return, and low risk equals low return. That's very, very simple. This is a very academic perspective. It's actually much more nuanced to that. So what I've got here is an asset class return, and I used to have this up on my wall. I've definitely spoken about this in other podcasts. So I remember 10 years ago I had this up on the wall, and then I used to have clients come into my office, and what they would do is they would look at investments that have done the best and just try and pick these. But the point of this is, you can refer to it as a skill chart or an asset return chart. And what it does is it shows for each year, it shows the different asset classes and how they returned over that 12-month time frame. So we're looking at 2009. This is 2009 was the year after the GFC. So 2009, people remember going, oh, GFC was pretty hectic. Australian shares did nearly 40%. So that was a plus 40%, 1st of January to 30th of December 2009 Aussie shares. What usually will happen is a top performing asset one year. The following years, it will be the bottom performing asset. It's just the way that the markets work. So take, for example, if we fast forward to 2022, we look at, say, for example, international property. So international property was the worst performing asset class of 2022. It's likely in future years that will actually be a top performing asset class. Doesn't make sense. It's always quite the opposite of what you think is going to be happening. It just tends to be the opposite of what you think is going to happens, which is why we need to maintain course. I'll take another one here. If we grab, say, for example, international property again in 2014 was a top performing class, then you see it drop down, drop down, drop down, drop down, and then again, it becomes one of the top performing asset classes. It's just how markets work. That the point is to have a well-diversified portfolio where you're tilting towards businesses that are growing well and being effective, without trying to pick this one versus that one. That's where you do get in trouble. So from an advisory perspective, we think risk within a portfolio that's managed well works best, as opposed to picking individual companies or investments, and then obviously maintaining the course and having a profile that's a good fit for you as a investor.
Yeah, exactly right. Harking back to last podcast or the one before, but the intangibles of having an advisor to coach you through the ups and downs, critical piece of the puzzle.
Final point on this one is I'm just going to show you. This is just from one of our peers that have put this together. So this isn't our numbers, but this is just an example on what some other planners are talking about. So I've got a high growth risk profile and a growth risk profile. And the difference is between what these guys are saying. Again, I want to clarify, these are not our numbers. This is what some of our peers are saying. A high growth profile has a projected annual return over a 7 to 10 year timeframe of 7.4%. So over 7 to 10 years, a high growth profile will be at 7.4%. That's what they're projecting. Alternatively, a growth profile, which has a bit more cash in it, a bit smoother, the projections are 6.7%. So about 1% difference per year, just by adding additional cash. It does smooth things over. But if you've got a long-term time frame, simply clicking a different box does improve your return. So that's why I do encourage people to consider this as not as I'm going to lose everything risk reward. I'm just going to have volatility in my portfolio during the next 7 to 10 years.
Yeah. Yep. Very true. I probably just think it's important to point out too, if you're sitting here watching this at home and that's inspired you to go and try and take action yourself and not speak to us first, but there's no laws around the naming conventions of portfolios in super funds, right? So you can go.
You managed to do it. Well done. Phil's bugbear.
I hate it. So you can go and compare.
I'm in a balanced portfolio. I'm just balanced.
That's right. So you can go and compare the balanced portfolios of all the different funds out there, and the name means nothing. Some of those are what I would consider to be as high growth as it gets. Some of them are considered to be too conservative. You need to look at the underlying assets and what they're actually holding and what they're invested in, because the name, despite the fact that they call it a balanced fund, it doesn't mean that it's a balanced fund. So
I'm going to again. Risk profile is important, but also making sure the investment mix does work. And true to label, I think there is things going through ASIC at the moment around actually being labeling. If you have a fund that's balanced, it needs to be actually called balanced, versus a lot of funds at the moment that are calling themselves balanced funds, but actually they have a growth to high growth portfolio in them, meaning they're going to outperform their peers because they've got more companies in them, but they're just not being true to label. So that's a real element to consider.
I was biting my tongue on that. I was wondering, the skeptic in me. That's definitely a trend I've seen over the last, 10 years, I guess. There's balanced portfolios becoming more aggressive, and the skeptic in me definitely thinks it's just a way to look better on the ratings chart, because
it's
not because they built a better balanced portfolio, it's because they put more growth assets in there and told you it's balanced.
Right. All right, we're going to leave it there. Thanks so much for listening, guys. If you've got any questions, please stay in touch. We really do appreciate the questions that do come in. Do subscribe on whatever platform you're listening to. It means a lot to us. We actually do see them. So we see you as you hit that subscribe button. And Phil, hope you have a great week. Thanks so much.
You too, mate. Cheers. Thanks. Bye, guys.
Bye.